me play the short side. So I'm still buying something. It's just I'm playing the downside in the market. It might be a little easier for an investor to get past that psychological hurdle of playing the downside when you can play the downside by buying something. And in this case, a put. There's also a limited loss scenario. Options actually, when used properly, are less risky. Why? Number one, you can only lose what you paid when you buy an option. If you spend $1,000 buying options, you can only lose $1,000. Not $1,000.02, $1,000. Think about what that means. That's an automatic risk management program that you have just by buying the option. Control what you risk by controlling how much you spend. We're also immune, and when I say we, I mean us option guys. We're also immune to the risks of stop loss orders. Everybody says, "Hey Ron, why do I need to buy options and have limited losses? I'm gonna limit my loss by using stop orders." Oh, really? Well, guess what? The thing is stop orders don't work when the market's closed. That means stop orders do not prevent you from getting hammered on catastrophic events. We've all had that gap opening where the stock that we owned opens down 40% and there's nothing we can do about it. Why? Because when the market closes, your stop orders go to sleep and they don't wake up until the market opens again. So that gap in between last night's close and the next morning's opening, you're a complete risk to, even if you have a stop order in. So they are less risky, these options, because they give us an automatic risk management program built in. Options are less risky than stocks when used properly. Better percentage return. Well, that's an easy one. Fact of the matter is, options have more leverage. And with more leverage, it's simple math that you're going to get a better percentage return. Why? Because you're getting a similar sized position for less money. If the position is going to do what the position is going to do, then if it costs you less money to get into it, you're going to have a higher return. It's just simple math. It's not smoke and mirrors. When you hear these option guys saying, "Oh, I had an 82% return last year," and you're saying, "How's that possible? The S&P was only up 3%. They've used leverage. They're getting more bang for their buck because they're controlling the similar sized position as you are, but at a much lower price because of the options cost efficiency. So what's happening here is their money is working more efficiently. Think about it. Money in the market, you're kind of like the boss. The dollars that you have in the market are like the employees. You want them to be working as hard as possible. Higher percentage return means that your money is working harder for you. Ultimately, that's what we want. So we're optimizing our investment dollar by getting a higher percentage return. Options give us that. And like I said, this is not a trick or gimmick. It's not done with smoke or mirrors. This is just simply the power of leverage used properly. Using options gives you more ways to win. There's more ways to profit when you're using options. Why? Because number one, now you have a very easy way of trading a bear market. We can buy a put option and take advantage of the downside. No longer are we trying to protect ourselves from losing money in our portfolio when the market goes down, but we can take the next step and actually start making money when the market goes down. We could just buy a put. And there's other bearish strategies that allow us to take advantage of downside movements in a fully hedged position, in a fully hedged way, with a limited, specific, known beforehand potential loss. There's spreads that we can do. Lots of ways of making money using options. We can not only make money from stock direction, but we can also make money by trading volatility. We have a way of isolating the volatility component of options and trading the flow and movement of volatility up and down. Can't do that with stocks. We can also trade the passage of time. Why? Because option prices consist of two different things: intrinsic value and extrinsic value. Intrinsic value relates the price of the stock to the option. Stocks don't decay, so that part of the option doesn't decay, the intrinsic value. But the extrinsic value, the amount of money of the option's price above intrinsic value, is extrinsic value. And that does decay over time. And because of that, we can actually make money and profit from stagnation. We can make money from a stock going sideways. It's called a premium collection strategy, and there's many of them. So that way, if we do run into a situation like Japan did after it had a combined market and real estate crash in 1989, putting its banks in severe problems for a long time and causing their market to go sideways for years, in case we run into that, using options allows you to make money during that period of time. You can actually make money off the lack of movement of a stock. Here's a big one: the ability to lock in profits without reducing the size of your position. That is huge. Think about it. How many times have you sat there and you bought a stock, it ran up, and you sit and you say, wow, I've got a 45% profit. It's too much to let go. It's too much to risk. I better take it. The only way you could take it is to sell your position. That will lock in your profits. But what happens when you sell your position? The position size is reduced. And eventually, if you sell all the position, you no longer have any position. And what normally happens? The stock keeps going. But here's the problem. If you're going to try to take advantage of that stock keeping going, you're going to risk a lot of money, aren't you? You're going to risk all that profit that you have. Well, here's a way, and there is a way in options, where you cannot risk your profits but maintain your positions. We call it rolling. Rolling. And rolling allows you to do something that you can't do in any other security. Locking in profits while maintaining the same sized position. Now what this does is if we could take our profits, a little at a time, a little here, a little there, and maintain our position while we're taking the profits, it removes our fear of loss. Suddenly we don't have a ton of profits in the market that's at risk because it's in the market. And we're not fearful of losing all those profits, those paper profits that we have, because we're able to cash them in as the stock continues to move our way. So this allows us to really let our winners run. We always hear that. Let your winners run. Let your winners run. If you let them run too long, they quickly become losers. And that's where the fear pops in. We've got money. We've made money. We've got a good trade. We want to take it. Why? Because we don't want to lose the profits. Fear. The rolling technique allows us to eliminate that fear. Why? Because we're not going to have a lot of profit in the market. We're going to take that out of the market by rolling our options and following the stock. We will roll our calls up as the stock moves up. Or if we're playing the short side and